If you're really good with your money, and you have the ability to put it off into savings and you're not going to spend it, then that's one option. But if you're not that type of person and you just need to get it out of your hands, then we recommend you go ahead and make the estimated tax payments.
Hey guys, Ray and Andrew here. Today we want to talk about how to avoid a tax balance due. This past tax year, we saw a lot of individuals owe a lot of money at times on their tax return that they may not have been prepared for, so that's always something that we try to mitigate as much as possible. So today we want to talk about some common reasons why an individual may owe taxes come April 15th. So Ray, what's one reason why someone may owe money come tax time?
So yeah, one of the biggest reasons that we see is just not having enough tax withheld on a W-2. Right. So our W-2 income clients, they assume that the withholdings are working correctly and that they really shouldn't owe much tax at year end because it's all being withheld all throughout the year. What they don't understand is the tax tables are a tricky thing, and it can cause you problems. So there's a couple of areas in the W-2 that we see problems with. One of them is that, if you receive large bonuses from your company. The majority of those companies we're seeing, they're doing a withholding of only 20% on those bonuses. Mm-hmm. And if you are a high income individual, and let's say your marginal tax rate is at 35%, and then you're getting a large bonus, let's say $100,000, for example, and you're getting a $100,000 bonus and they're doing withholdings of 20%, well, that's 20 grand. But if your marginal tax rate is at 35%, then your taxes are going to be at $35,000. That's going to leave a $15,000 balance due. Mm-hmm. So that's where we saw a lot of deficiencies this year and had to help clients understand what was happening because it was causing a lot of balance dues.
Yeah, it's really hard for high income earners who earn big bonuses throughout the year to have enough withheld just through normal withholdings. Right. It definitely catches people.
Absolutely.
Another one would be about the spouse. What can you have like a spouse's own?
Yeah, so another issue that we see, we'll have two spouses that make decent income, and then whenever you add their income together, it's really good income. So let's say spouse one, let's say he makes $100,000 and his effective tax rate is 20%, and spouse two makes another $100,000 and hers is 20%, so they're having 20% withheld. Well, if that was the only income that each of them received, then they would probably be okay. But when you add the two together, puts it into a higher effective tax rate, mm-hmm. and then they end up with a tax withholding deficiency. So whenever you have two working spouses, you really need to make sure and coordinate your withholdings to make sure you have enough withheld.
Gotcha. So so now that I know some of the reasons why, like what can I do to make sure I'm having enough withheld?
So there's a couple different things you can do. One, you can come to us and we can put together a tax forecast for you and give you an idea of how much of a deficiency you're looking at, or you may be withholding a fine amount, which is great. But we like to be able to find out those deficiencies early. That way we can correct them. That way you have enough withheld throughout the year. So tax forecasting is one way. The other way, if you wanted a free option, you can go to the IRS. They have what's called a W-4 withholding calculator. Mm-hmm. And what you do is you go in there and you can put in all your year-to-date information for you and your spouse and all your other forms of income. And it will even tell you how much you need to have withheld for the remainder of the year and how to adjust your paycheck to make sure you're covered by year end. So that's a really good option. The other is to make estimated tax payments. If you are aware that you're deficient, go ahead and start making some estimated tax payments. That way you don't have a big lump sum due at year end.
Gotcha. So being under withheld on your W-2 is one thing that we see a lot that catches people to where they owe balances due. Another is having income flow into your tax return that doesn't have any withholdings on it. What types of incomes would that be?
So we see this a lot with people that own stocks. They have investments. What they'll do is, especially if they had a really good year and they decided to sell some stock and recognize some capital gain. And what we'll see is people that let's use that same $100,000 example again. They sold some stock, had a $100,000 capital gain, but took that same money that they got from the stock sale and buy some more stock. Well, a lot of them don't understand that gain was triggered. So that $100,000 capital gain had zero withholdings on it. So that's going to result in you owing additional tax.
Yeah, it's a tough pill to swallow when you have those capital gains that are being reinvested. So you never really received the money, but it was reinvested into a new purchase.
You got to think about that when you do that. Make sure you have the money to pay the tax.
For sure. So, and also like our business owners, they have flow through income. So,
yes. Yeah, we see that a good bit where we will get business owners that come in and they have not been making estimated tax payments. They weren't aware of it, or it's their first year as a business and they should have been making estimated tax payments. But it's usually, that small business owner with flow through income or a Schedule C, and they end up having a decent balance due. One of the ways that we try to mitigate that and try to catch that on the front end is to do some tax planning for them, to give them an idea of the balances due, so that way they can either start making estimated tax payments or put the money off to the side to pay whenever taxes come due. It's all about being aware that the balance is going to come, and then depending on who you are, you can either make the estimated tax payments or put the money off to the side. If you're really good with your money, and you have the ability to put it off into savings and you're not going to spend it, then that's one option. But if you're not that type of person and you just need to get it out of your hands, then we recommend you go ahead and make the estimated tax payments. But we really try to encourage our clients to be proactive about these type things and understand their balances due, because once it becomes April 15th, we can't do anything for you, right? We can't make any suggestions. It's just hard on us. At that point, we're just dealing with what happened. Mm-hmm. And those phone calls, calling a client and telling them that they owe $10,000, $15,000, $20,000 are some of the worst phone calls we have to make. So we try to avoid that as much as possible. We always call, and then we go through these same things with them as well. We explain to them why they had the balance due and what they can do to mitigate that in the future, so that way they can lessen the likelihood that they'll have those balances due.
Right. Awesome. So the biggest takeaway here is just have some understanding of your tax situation. Don't always assume that you're having enough withheld, because there are situations where you can get tripped up. So I appreciate you going through that with us, Ray.
Awesome.
Thanks.